Welcome to the Breakthrough Advisor Podcast. In this podcast, we inspire advisors with ideas and pathways to break through barriers and build a thriving retirement income business. We will interview innovative technology developers, business leaders, and successful advisors, then help you organize and execute these ideas to move your business forward.
Welcome, Tamiko. Thank you for joining us on the Breakthrough Advisor podcast. We've heard and read a lot from you over the years. We really appreciate your contribution to our industry. You've done great things to help the consumer and the advisor both get a better understanding on annuities. And for all of that great work, thank you very much. We appreciate it. There are a lot of different directions we could go in today's conversation. Let me just start with a simple question. So tell me a little bit about, what's on your mind and the work you do at CANNEX. What are you guys working on that's going to blow our mind, later in 2021?
Wow, that's a great question. We certainly have a lot of things. What I guess I'll start with is actually something that's new for us from the research perspective. We have a new research partnership with the Alliance for Lifetime Income, and we just released our first joint study, and we're actually hard at work on the next one. So things don't really tend to stay still, but we have some, really great insights, I think, that are going to help us in general understand what's going on and really how to help advisors and investors come together to create better outcomes.
So the first study has kind of been out, for a little while. I think it came out earlier this year, right? Maybe Q1, end of Q1, beginning of Q2, something like that, right? And so one of the things that was interesting about that was this disconnect between what consumers think about annuities and what advisors think about annuities. Can you talk a little bit about, the findings there?
Yeah. So, I just want to say in general, there's this perception that people dislike annuities and they dislike the word annuity. And I think that that's really a distraction. We have generally found that the interest of regular consumers in an annuity solution is actually pretty high and generally much higher than a financial professional expects it to be. But I think one of the real great proof points in this particular study is that we asked the investors how satisfied they were with their financial professional, and they were more satisfied when they had an annuity than when they didn't. So the difference is 84% were very satisfied when they own the annuity versus 74%, which isn't necessarily a tremendous difference, but it's a positive difference. And I think that really disproves the trope that people fundamentally dislike annuities.
I think you're onto something there. I think so. Maybe that's some form of cognitive dissonance. Where we felt that way for a while, and now we need to think a little bit differently about it. So, what's changing in the minds of the consumer that's bringing them more in alignment with the idea of annuities? I honestly don't think that anything's changed for regular people. What they love is what annuities do for them. And the problem is we talk about annuities generally from a bottom-up perspective, but what type of product is this? Oh, it's a fixed annuity. It's a variable annuity. And then it's got this rider, or it doesn't have a rider, and it does X, Y, Z, and it's attached to an index. Or, we talk about it from a structural perspective, but not really the solutions perspective. And so, I think that this is a little bit of a self-inflicted wound. The industry has been fantastic at innovating so many different types of annuity-based solutions and continues to do so. It's not going to stop. But I think that how we talk about them, as long as we start from the place of what matters to the investor, I think that's what really resonates with them. So you make a good point, and I have to say, in some of the conversations I've had, with our own personal clients about annuities, typically three things come out, in the conversation. They seem like they're expensive. They seem like they're complicated. And, if I die, who's going to get the money? And so, if you understand annuities enough, you understand that those three things aren't true of all annuities. And those three things don't have to be true of an annuity that may be a solution to a problem that a particular client is having. Have you found anything similar in that vein, or?
Yeah, absolutely. I think that there are a lot of preconceptions and misunderstandings in general. But even when you go down the basic list of they're illiquid and they're expensive and yada, yada, like you say, they apply differently depending on the structure. And, I even would push back against the expensive component, but because that's not really how I like to look at them when they're there for a certain solution. But without getting bogged down in that, for a lot of financial professionals, I think they have gotten stuck in their own ideas about how products work, right? And I think that there's actually a tremendous need for an education effort to help them really get to this idea of understanding the solution set and gaining confidence in how to apply those solutions so that they can really guide their clients through the process of deciding that this is the right solution for them.
So I want to come back to a comment you just made, and that's, are they expensive or not? And I think for some of us, expense, depends. The expense is relative to the value that you get out of it, right? And so I think you've written a little bit on this area where I think it might have been income annuities or income riders, where if you look at what you're getting out of it compared to what you're paying for it, that it really is a fair return. Do I have that right?
Absolutely. And so I just want to start with one basic premise, which is that everybody should get paid for their work, right? This applies to financial professionals, regardless what their compensation model is. This applies to insurance companies. It actually also applies to mutual fund companies. We sometimes act like, they're altruistic and they don't, actually make money on the work that they do. But everybody gets compensated for what they do, so do insurance companies. Now, whether or not you see a fee, it doesn't make one thing more or less expensive than another. A fixed annuity, all you see is a rate. That's fine. But it doesn't mean that there aren't underlying costs that the insurer is compensated for. It's very similar with a different chassis, like a variable annuity. It's just that you have everything exposed. So you have these explicit costs, right? And even with a RILA, right, where there might be a fee for the underlying contract, but maybe then there's not a cost for the quote unquote investment because there is no investment. And that gets expressed in a different way that's actually more similar to a fixed annuity. So it's like a sort of like a cost blend of those things. But ultimately, if you're paying for a benefit, then that is making the thing quote unquote very expensive, then you're getting something out of it. And if you don't need the thing that you're paying a lot of money for, then maybe you shouldn't be buying that in the first place. But it's a matter of matching the need to the product.
So I want to come back to something you said a little bit earlier from the PREP study about how maybe the attitudes are changing, maybe they aren't, It seemed to me that there was something generationally in that study as well, that maybe the Gen X folks were more receptive to the idea of annuities than boomers are. What do you think is contributing to that situation?
Sure. So, when we talk about the retirement crisis, we talk about the three-legged stool, right? And that one leg is pensions. One leg Social Security, and then the other leg is going to be your retirement savings, right? And then when we talk about pensions, we say pensions are disappearing, but they're not disappearing evenly across every age group, right? They're more prevalent among the older folks. So the older boomers are most likely to still have a pension. And you see that declining through the younger cohorts. So this really explains why it would be that Gen X would have more interest. It's because they're more likely to be missing one leg of the stool in their own personal situations. So even though Gen X doesn't generally get a lot of attention, and it's a smaller group than the boomers are, we still see really there's a large population of folks that are interested, and you can project that forward or backwards, however you want to look at it, to the millennials. And there are other studies that have focused on those folks, and that they are very interested and they're very worried about retirement. And I think that it's probably more complicated than simply the lack of a pension, but I think that that's a very significant contributing factor.
So where does the individual's personality come into play in the way they look at this? Or I think Wade Pfau's got some research coming out under the label RISA. And so retirement income style awareness. So we're saying that we all reflect our preferences in terms of how our income is guaranteed or supported or protected in a number of different ways. I think you were talking in one of our calls last week about your thoughts on that. Where do you land on that situation?
Yeah, I mean, I love this framework. It's very different from how do you solve the problem, but it's really approaches it from the perspective of how do you solve the problem in a way that works best for you, the individual person. Let's not think of them as an investor, but it's a human that has certain preferences, right? And so let's map those preferences and then figure out what types of solutions fit that map. Now, what's very interesting about those results Wade and Alex published a study earlier this year on this. And basically, when you look at two of the quadrants, one is really leaning more towards the safety first, income guarantee perspective. And then the other one is really more of a portfolio management solution, right? Where you're not necessarily using income guarantees. And that's pretty much evenly split in thirds between those groups. Now, by pure coincidence, we actually happened to ask some questions in the last study of financial professionals, and we wanted to know what type of solutions they offer their clients. And so we asked about certain quadrants, and basically one of the findings that's very interesting is most financial professionals use one style. They don't necessarily have a lot of different tools in their toolbox. And you can see that might be a fundamental problem in interacting with a wide variety of clients. But what we found is that only this is a little over 10% of the folks that we spoke to actually use the safety first perspective, right? And so it seems like, and it's a very easy one to implement, and it seems like you're missing out on serving your clients best if you really only see retirement income planning through a single lens.
Let me level set for the audience for a second. We did a podcast with Wade Pfau earlier this year, and what he found was that people come at one end of the spectrum or another. They're either very safety first. If you ask them, are you comfortable with the results, 90%, 5% probability of success with a Monte Carlo simulation, they're not so comfortable with that. At the other end of the spectrum, you've got folks that are more comfortable with market-driven solutions. And what Wade said is, all right, so now if we lay these personalities, these style awareness boxes out, it's not that there's a problem with the annuity or the solution. The problem is in which tool are you recommending to which quadrant. If you're talking to someone who's market-driven and you're talking to them about annuities, you may not have a receptive audience. Now, if you're talking to someone who is safety first and you're talking to them about a market-driven, probability-based approach, again, you're not going to have a very receptive audience. And so what their research is saying, and what I think Tamiko is saying, is you got to be flexible. You've got to read the room. You've got to understand the prospect you're talking to. And so this is another level of know your client and addressing their particular style awareness. So where does that leave us, from a solution perspective, as far as you're concerned? Where do you think that takes us?
What I would love to see, and where I think that we are moving towards as an industry, is a place where financial professionals get access to a wider variety of tools from a planning perspective, from a product placement perspective, comparison, all of those things, so that they can meet the client where they are. And they're not simply always using that hammer. We want them to have a hammer and have a screwdriver and, hopefully have some other tools as well. But at least let's look at this as a problem that has multiple different types of solutions to kind of get to the same place, but focus more on client satisfaction. So I think that is just really going to drive better outcomes overall and improve the confidence of the investing public in the advice that they're getting, which, there's a lot of distrust out there. And this would go a long way rather than saying, I'm going to shove this one solution down your throat, whether you like it or not, because this is the only thing that I do. They say, let me hear what it is that you want and need. And then we'll come together on that.
Another verse in the same song, I think, is this notion that if the annuity product isn't, an advisor only, isn't fee only, then it's not the right solution. Whereas if it's got a commission in it, then it's the wrong solution. So, what's your research telling us about that approach?
Well, I just have to say this is more anecdotal than anything. But look, let's look at the sort of cast of characters out there and the percentage of product that is advisory structured, right? And it's relatively small. And so what happens is if you limit yourself only to those products based upon the compensation model, which I understand where that thinking comes from, but you may be restricting yourself from best-in-class product. And this is what I'm hearing sort of out in the field, right, from folks that are looking at all these different products. And I think that there can be a little bit of a slavish devotion to a certain comp model. And that ultimately may not be the best thing to serve the client.
So I think one of the areas we talked about last week was this idea of the income riders with indexed annuities. One of the things that was interesting to me is you pointed out that they're not gender based. So help our audience understand a little bit about what that means and why that should be important to us in looking for income solutions.
Sure. Well, I'll put this into context. First of all, just the background on this is some of the work that CANNEX does around income valuation. So we actually can assess a variety of different products based upon the specific design and for a client case to say not only, for like an income annuity, but an FIA that has a GLWB, et cetera. What is the income potential of that product for that individual? So we actually did a study a few years ago, and we started comparing the basic income guarantee. So this is not including the potential for increase from the markets or indices, but just what is the fundamental guarantee that's coming out of this range of products. So VA and FIA with GLWB and income annuities. And what we found was that in a lot of cases, the FIA actually was outperforming the sort of purpose-built product, which is counterintuitive. So, particularly on day one, it's generally speaking, the single premium immediate annuity has the most income, but with a delay in particular, we saw that dynamic change. Now, where the dynamic changes the most is for women, because most FIA GLWBs are, the income is not linked to the gender of the annuitant, whereas for an income annuity, it most definitely is. And that can actually drive a difference in utilization of what's the most efficient. So it may well be for a man, like we saw this scenario play out. For a man, the highest income would come out of a deferred income annuity, but for a woman, it might come out of an FIA. So we really saw the need when income is a critical outcome and you're trying to maximize that. It does actually make sense to look across different types of products and consider the characteristics of that person.
So that's a great object lesson coming back to a comment you made earlier, which was look at the outcome, not the fee or the compensation model, right? So your research shows that FIAs with GLWB for women generally, with a little delay is going to produce better income than DIA. But we traditionally think of DIA as lower expense, lower comp, right? Which is interesting to me. So I think what that speaks to is the need to do your homework and, be aware if you've got a bias and try and manage that bias, right? I'd like to come back now full circle to your opening comment where you talked about satisfaction. So talk about a little bit more for us about what the study found in terms of people's perceptions of annuities versus what advisors were saying.
Yeah, so generally speaking, that's sort of a consistent thing that we found is that people tend to be much more interested in annuities than advisors predict, and more true with people with fewer assets. Although I think that there are probably some different influences in that. But the expectation of the financial professional is often that this is going to be sort of a hard sell, something very difficult to convince them that it fits well in a plan because of this very prevalent idea that people dislike annuities. Although I have to say that there is some discounting. So, we've in the past, and other people have done this as well, sort of explained what an annuity does. And people generally like it. And then you call it annuity and fewer people like it. But people generally still like it, actually, because when you're describing it as an annuity, you're also saying what it does. So it's not like it completely, the desirability of the solution completely falls off the cliff with that. So I think that one of the things that can happen, though, is that if you're sitting in front of a client and you're thinking that they're going to not be receptive to the message, then you may have your own internal barriers. But again, if you start from a solutions-based approach of what does this thing do, let's not worry too much about what it's called or like, is it a fixed or variable annuity or, how it works. Like how it works, obviously you need to be able to explain that, but it's what it does that is the crucial point for the client. And ultimately that's what serves the plan as well. I mean, those other details don't serve the plan.
Yeah, I think one of the stats that jumped out at me from that study was the one that said 9 out of 10, and I don't remember if it was just Gen X or Gen X and boomers, expect their retirement plans to provide them with guaranteed income and or principal protection, which to me really speaks to the two big solutions that we expect from annuities, right?
Yeah, absolutely. People like the idea of protected income, right? And again, when the financial professionals are underestimating this, which they do, then they're really depriving themselves of the opportunity to serve the client and to provide a solution that the client actually really wants. So that the reminder out there that this is a value proposition that people want. Again, let's not get too caught up in some of the terminology, but what does this do? And what is that client like? What are their preferences, right? Which is something that's ascertainable, as well as, what are the needs and how does this fit within the context of a retirement plan? Which is actually just another really good point because we found in the past that clients are much more satisfied when they're with an annuity when it's part of a plan. Like it doesn't do great as a free floating ion out there.
Gotcha. And, I love the takeaways from this. I love the idea of rethinking how the conversation goes with the client, between probability based and safety first. I love the idea of thinking about the net benefit that you're deriving versus the expenses. And I love the idea of thinking about creating more client satisfaction because Lord knows with the money in motion that we're seeing today, post-COVID, those rates are up 350%. And the data says that if you're an advisor and you happen to be in communication with one of those clients who's a little bit dissatisfied with their advisor, you got a 19 times greater chance of converting that client than at any other time in the life cycle. So to all the advisors listening, have an open mind. Think about, a research data-driven approach to income solutions and to dealing with the different personalities that folks have by carrying more than one tool in your bucket. So Tamiko, thank you very much. A super enlightening session. Really appreciate your contributions to the industry and particularly to our podcast this afternoon. Thank you very much.
Thanks for having me.
Matt.
Yay, we talked about Generation X. Oh my God. I've been harping at Jack Tomiko for so long about this that, there's this whole forgotten generation that's in their peak earning years who'd have no pensions, and somebody's got to create a damn product for us. And I'm so glad you guys covered that today. And the other thing too, and here's what I am confused about. And obviously as a marketing company, this is very important for the success of this podcast and other podcasts is, how do we get past these closely held incorrect beliefs? I don't, it's like, I know an advisor who's, I would consider intelligent, right? And you say the word annuity and he starts like twitching and stuff. And he would rather run a Monte Carlo simulation and charge them 2% every year, by the way, 2% for the lifetime of the client. And he's saying annuities are too expensive. So how do we do this, right? How do we get people like you out into the marketplace and having them, besides this podcast, but so that more and more people can hear this message? Because a lot of the people who subscribe to this, some of this is preaching to the choir, but empowering them to have more confidence, which is very powerful for a podcast.
Yeah. And the confidence piece, by the way, I think is crucial as far as being able to make a recommendation. And so some of the stuff I can't really talk about in the study, that when we were asking about utilization of different products for different solutions, and they were like so wrong. Like they were picking stuff that was like, no, that product is, they say, like basically something that's illiquid, like for guaranteed income accumulation, illiquid. And there are people that check the box for mutual funds and ETFs.
Wow.
What is wrong with you people, right? Or talking about income with liquidity and then checking out the box for SPIA. Like it's completely ridiculous. So, I mean, I think that there's a huge opportunity right now for education across the board, right? And we've been working really hard to try to debunk some of the myths. And that's one of the reasons we started doing the interview series that we have. It's not a pod. We've never converted it into a pod. We're using just the video format, but we talk to people about how these products are built. How are they priced? I actually have an interview queued up that's going to go into detail on FIA pricing, like the internal pricing. Well, why would you buy this product rather than just buying the instruments yourself? And I have a guy who really, really knows how these things work. And he's going to tell you why it doesn't make sense to do that.
Sure.
Right. So, I mean, I have the soapbox about talking about annuities from the solution perspective, right? This has been my thing. I'm actually writing a piece for the Investments and Wealth Monitor right now, in which I'm recategorizing, like, this is how we need to talk about it, right? So I just think it's a matter of education to the financial professionals, and some of them need a combination of the quant component, but they're having a very emotional response.
Yeah, totally.
Right. And so meeting that emotional response with the issues of client satisfaction, and then say with the RISA, however you pronounce it, I was just emailing with them actually like half an hour before we got on the call. But, like this format, what I love about it is that it tells the FPs they need to look at other ways of solving the problem, not because of the quant stuff, which they still aren't convinced by, but because that's what their clients are asking for.
Yeah.
And so I think it's okay for them even to believe it's not as good of a solution and it has all these flaws. If they're like, no, this is what the client is asking for. I'm going to meet them where they are, and I'm going to do it in a way that's like kind of okay for me. May use a limited product set or what have you. But I mean, those are some things that I think about with this.
Well, so just so you know, and this is not a shameless plug for me, but just something great opportunity for you is you can take the MP3 out of the video and literally just upload that and turn it into a podcast. It's that simple because what we're finding is there is a very strong subset of people who will watch your video, but they're not watching it. They're just listening to it because they put it on YouTube and it'll be playing in the background, but then it's not portable, right? So that's why this is such a powerful medium and why I was luckily able to convince Jack that this was a great idea for InsureMark, is because it is very, very portable. People listen to this in their quiet time. And I always joke with Jack and say, to his reps, when's the last time that you were invited into your prospect's quiet time? Without being creepy, because that's an important component, right? Because some people are like,
well, be careful. I think Tamiko's in New York. Speaking of creepy guys. So where's the interview hosted? Where are you putting these, Tamiko?
We host everything on YouTube. Okay. And then we have a section of our website.
So it's on CANNEX.
So it's all on CANNEX. So what we do is we produce a full-length video, and then we create a bunch of short clips.
Gotcha.
Right. And then we also create a Q&A document for people who like to read. And my plan has always been to convert it to a podcast, but I just been a little bit busy. And also I didn't want to get into the commitment of we're going to do these once a month because our production on this is sketchy at best. Mm-hmm. But it's been super successful for us, and we have some great things. I did a CE class on FIA recently, and I think there's a lot of room for education on that topic.
Yeah. So are you getting Lawrence to talk about the mechanics of indexes and annuities?
He did.
Okay. Gotcha.
He was our first interview, actually.
Yeah. He's awesome. Yeah, we had him a couple of weeks ago, right, Matt?
Yeah, it was only a couple of weeks ago. Yeah, that was way out of my league. Like I had no idea what was going on there. But it was because, Jack got into the weeds and you, just like you said, there are quants who want that, who want to be able to, okay, I get this now. This makes sense to me now from that level of granular understanding, right?
Well, thank you very much.
Thank you for listening to the Breakthrough Advisor podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of InsureMark. The content has been made available for informational and educational purposes only.